Hello and welcome to today's video. In today's video, we'll take a look at a very interesting topic, which is as an investor or as a person who's looking to create a dividend portfolio, should you be investing in high dividend yield stocks? So let's get started. This is what we'll cover. First of all, I'll explain my definition of what is a high dividend yield so that everybody is on the same page. And then we'll move on to see whether this high yield actually makes sense. Is it a good investment decision or is it a value trap? Is it something that you should avoid? And finally, once we understand these concepts, I'll let you know how you basically identify stocks which are actually high yield dividend stocks, but at the same time, they are safe investments and they are not value traps. A quick look at the disclaimer, which basically states that any information that I'm sharing with you in this video is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to trade or invest your money, please get in touch with a certified financial advisor and understand the risks before trading or investing. And a quick look, this is something that I've been mentioning in a couple of my past videos, that whatever trades I take, I basically put them on the community tab of my channel. So if you want to follow my exact trades, you can go to the community tab of my channel, Serene Trading Strategy, and there you will be able to see all my trades listed there. So usually when I take a trade, within a couple of minutes, 5, 10, 15 minutes, I put the trade there. So if you want to get immediately notified as to when I have taken a trade, please subscribe to the channel. That's all you need to do, because once you're subscribed and you enable the notifications, as soon as I create a post by posting the trade on the community tab, you'll get a notification and then you can go and follow my trades. So this kind of service where people share their trades is actually a paid service. Most of the places you can go and see it, but for my case, for now at least, I am putting these trades out for free, and we also keep a track of the profit and loss that I'm making, the running profit and running loss. And I mean, just watch the trades, you can follow the trades, and most of my trades are swing trades, so you don't have to worry. I don't get involved into day trading, so these trades are valid for somewhere between 2 to 40, 45, 50 days sometimes. So even if you don't see the trades immediately, it doesn't matter, but you have an option. If you subscribe and enable the notifications, you'll get immediately notified as soon as I post the trade. So first thing, let's understand what is a high dividend yield, right? So different stocks have different dividend yields. Some stocks will pay out less than 1%. Like if you consider the most popular companies out there, Microsoft, Apple, their dividend yield historically has been less than 1% or 1 point something percent. And these are low dividend yield stocks, but they have a low dividend yield for a reason. The reason is that these are growth stocks as well. So the way a stock can give returns to the investor is in multiple ways. One is that they give dividends. So dividends are quarterly payouts or yearly payouts or monthly payouts. It depends from company to company, which are basically cash payouts given to people who are holding shares in those companies. Another way is that the company may not pay out dividend. It may do share buybacks. So initially, let's say company has issued 100 million shares, and over a period of 5-10 years, it has bought back half of the shares. So if you bought a certain number of shares, now the value of the shares may have not gone up or down, but if half of the shares have been bought back by the company, outstanding shares have been reduced to half. So essentially, you own double the percentage of the company as a shareholder. So this is how the returns are given back to the investors. The third way is growth, and by growth, what we mean is that you bought a company, a stock of a company, let's say at $100, and the company has been doing well. They've been increasing sales, they've been increasing their profitability, and the company's been growing, they've been expanding. So as a result of that, the stock price has gone from $100 to $200 to $400, and so this is the growth. So there are different ways in which returns can be given to an investor. One of the ways is dividend yield. So dividend yield can be low, can be high. It depends on what kind of the other returns the company can give. If you see very high growth companies, look at Facebook. Now it's called Meta, but look at Facebook, look at Google. They don't. Facebook doesn't pay a dividend. Tesla doesn't pay a dividend, but these are high growth stocks. So they are basically reinvesting all of their money back into the company because they feel they can return a higher value to the shareholders by investing and expanding their business rather than paying out the cash in the form of dividend. So definition of a high dividend yield is not fixed. For some companies, a 1%, 2% dividend yield can be high enough. For other companies, which basically have flat growth, they are kind of occupying the entire market, there's very limited scope for growth, then the returns have to come back in the form of share buybacks or dividends. So you have to understand, when you evaluate the returns from a company, look at all these three possibilities and see what combination is applicable. Don't just look at high dividend stocks, because if a company is paying a high dividend but it has no growth, it has no basically share buybacks, then you're only getting returns in one form. Whereas if there is another company which is doing two of these things, although the dividend yield may be slightly lesser, that may be a better investment. In general, any companies which pay in excess of 5% dividend yield, I consider them to be high dividend yield paying companies, because most of the companies which are considered as dividend stocks, they will pay somewhere between 2 to 4%. So 2 to 4% is the norm. Anything less than 2% is a low dividend yield. 2 to 4% are considered the actual dividend stocks. Anything more than 5% is a high dividend yield. So first thing is, are high yield stocks good? So I have a complete video on one of the concepts which we need to understand, which is the payout ratio. So I'll briefly just call it out here. If you want to understand this video in more, this particular concept in more detail, you can watch this entire video. I'll leave a link in the description, and it'll also pop up in the cards in the corner. So you can click on that. You can pause this video, watch that, and come back here. So payout ratio essentially means what? Dividends have to be paid out from somewhere, right? So the company generates income every single quarter, and from that income a portion is paid out in the form of dividends. So let's say a company generated a net income of $100 million, and out of that they basically decide to pay $10 million in the form of dividends. Then this 10 million as a percentage of the net income, which was 100 million, is 10%. So we'll say the payout ratio for the company is 10%. So payout ratio becomes a very, very important metric, and all details regarding payout ratio are covered in this video, which is linked here. So you please go and watch that video for more details. But we do not want payout ratio to be very, very high. The reason is, if payout ratio is very, very high, let's say it's 80%, 90%, what that means is that the company is paying out a huge portion of the net income that it makes in the form of dividends. So what if things go wrong? What if there is a macroeconomic event, there is a recession, there is a slowdown, or the company has some internal financial challenges which it needs to handle? It is not going to be left with any cash, because just in order to maintain that dividend payout, they are giving away most of the cash that they make back to the investors. So very little is being retained in the company. And low retention means two things. One, the company doesn't believe too much in internal growth. So that is first thing you need to catch from that. Imagine if your business is growing and you make a profit, you would invest all of that profit into expanding your business and growing that business, right? So your returns to the shareholders or investors would be in the format of growing the business, not in the form of paying out dividends. Only when you feel that you cannot grow your business anymore, you, even if you are making a huge amount of net income, you cannot invest that money anywhere, you don't have any plan to invest or grow your business, that is when you will not know what to do with this money. If you just keep the money with yourself, then your return on capital is going to fall down. So in that case, you will start paying out dividends. So one thing you have to understand is, you have to look at the payout ratio. If the payout ratio is somewhere between 20 to 30% or lower than that, that's a very, very healthy payout ratio, because it indicates two things. One, in case of any financial distress, this company will be able to handle its dividend payout along with the trouble that it is facing very, very easily. Why? Because it is only using a small percentage, 20 or 30% of the net income it makes to pay out the dividends. Rest of the money is being retained in the company, which can be used in times of financial distress. Also, in times of financial distress, this kind of a company doesn't have to cancel its dividends. Why? Because it still has 70% left over to look into its financial problems, maybe some debt repayments or some capital investments that the company has to make. The second thing is, when the dividend payout is low, payout ratio is low, a lot of cash is being retained, which can be used to fund the growth of the company. So let's say a company needs to set up a new plant. It doesn't have to go out and look for debt. It doesn't have to dilute the shareholders by issuing more equity. Why? Because a major portion of the net income which they are making every single year from its operations is still available with the company for reinvestment purposes. So I'll not go into more details here. All this is related to the payout ratio. So I would highly recommend that you go to this video, watch this video that is linked here, and then come back. So all concepts around payout ratio and its significance will be absolutely clear. Next thing is, how do we identify high yield stocks, right? So we understood the concept that necessarily any stocks which have a high dividend yield are not good, and any stocks which have a low dividend yield are not necessarily bad. So how do we actually identify stocks with a high dividend yield which are actually good stocks? Now, one reason why you would want a high dividend yield stocks, because as I said, returns to shareholders can be in the form of growth of the company, can be in the form of share buybacks where you start owning a higher percentage of the company, or in the form of dividends. Dividends become very, very important for long term investors who are also looking in parallel for a significant amount of regular quarterly or monthly income. So all of us just cannot put our money into an investment and then forget about it for the next 15 years. We do need some kind of a payout every single month, every single quarter, to meet our expenses every now and then, right? So for those people, dividend investing makes absolute sense. Why? Because you still get the growth from the long term investment. You may also see the company buying back shares, but when dividends are being paid out, you actually have a monthly or a quarterly or a yearly income stream, which depends on how the payout is decided by the company. But this income stream can help meet some of your expenses which you have to bear on a monthly basis. So if you want to identify high yield dividend stocks, but not compromise on the fundamental aspects of the company, not compromise on a bad payout ratio and other parameters. So for that, I have already created a screener using the Finviz platform. So there are two videos on my channel which I would recommend you to watch. The first one that you can see here is the Finviz stock screener settings for dividend stocks. And the important thing here is the filter doesn't tell you which companies pay a high dividend, it actually tells you good companies. So first thing is we need to find out good, healthy companies with good managements and good business models which are paying a high dividend yield. At the same time, we want the payout ratio to be reasonable. It should not be very high. So if you look at this video, you will basically see all the screener settings that will not generate just a list of high dividend yield companies, but it will generate a list of high dividend yield fundamentally strong companies. So I highly recommend that you go and watch this video, because once you watch this video, you will be able to, you don't have to depend on somebody to tell you which company is good or bad. You can actually go run the screener settings every day, and then when you see those companies listed out there, you can do further research to see if they satisfy your investing criteria. The second video that I have linked here is about how to increase or double the dividend yield, because I have shown this, and right now if you watch this video it will make perfect sense. Why? Because the concept that I discuss here, I'm not going to explain it in detail here, you can watch this video, is applicable in today's times when the markets are actually crashing, and you will understand how you can effectively double or even triple the dividend yield on your favorite dividend stock. And so I would highly recommend that you watch this video. If you watch the three videos that I have linked here, you will basically understand the ins and outs of dividend investing and the caution you need to take, because some companies will have a very high dividend payout ratio, sorry, high dividend yield, like 15-20%, but if you go and see behind the scenes, they are actually incurring losses because they are paying out more money in form of cash to the shareholders than what they actually make. So that dividend we know for certain is not sustainable. But most retail investors will just look at the dividend yield. Okay, this company pays a 15-20% dividend yield, excellent investment, let's get in. What they fail to understand is that this is not sustainable. Over a period of time, the company is going to deplete its total cash reserves, and in case there is a financial distress or some kind of macroeconomic event, this company will eventually run into bankruptcy. So please avoid all that problems. Watch these videos, and these should really help you understand the nuances of dividend investing and what's the best way to select stocks where you get growth in all three ways. You get growth from the expansion of the company, from the business of the company, you get growth from the buybacks of the company, you're not getting diluted, you're not losing value, and you also get growth because of the dividend payouts. So I hope this video was useful. If you have any queries around this, please leave them down in the comments section and I will definitely respond to you. If you want any other concepts around dividend investing also to be clarified, please again leave them down in the comments, and I'll probably see if I can explain them in the comments itself, or if it warrants a separate video. If you like this video, please like the video and subscribe to the channel. Share this with your family and friends. And as I said earlier, all these are concepts in my videos. Mostly I am discussing the concepts for trading and investing. But if you want to really see these in practice, then you can watch the actual trades that I'm posting on my community tab. And all you need to do is subscribe to the channel and enable the notification so that as soon as I post a trade, you get notified, and then you can follow those trades and see all these principles and concepts being implemented in practice. So thanks for your time, and I'll catch you guys in the next video.